Vantage Point with True North Wealth Partners is for our clients and those wanting to learn more about what's really going on within the markets and economy, as well as overall financial planning topics.
Welcome, everybody. Vantage Point with True North Wealth Partners. Eric Susi.
Russ Long.
Welcome to episode number 6. Oh, my Lord. Where's the year gone? Today is Friday, December the 11th. I can't believe it. So welcome. Thanks for joining in. We have a lot to cover today. I want to welcome Russ, an inaugural episode here with us, and glad you're able to join and help out. Andy's couldn't make it today. He's a bit tied up with business. So Russ, thanks for coming down from Worcester. So Russ Long is our newest advisor and financial planner here with True North. And just tell us a little bit about yourself briefly. We have a satellite sister office out of Worcester, Ohio. So share us more.
Well, thanks for having me, Eric. I really do appreciate coming down. As Eric said, my name is Russ Long. I'm an advisor in the Worcester office. It's a recently opened office, just opened about 6 months ago. New to the industry, learning as I go. Somewhat. Just so everybody understands, I come from a legal background. I am still a practicing attorney with a law firm. I'm actually a magistrate as well in a common police court here in one of the counties of Ohio.
So when I get pulled over, you can help me out?
No.
Oh, gosh. I thought I could pull a favor.
No.
All right.
But I am a Buckeye, graduate of Ohio State University. And like I said, we have the True North office in Worcester, 124 North Walnut Street. Suite 19 is our location. Phone number is 330-946-3648. We are the building that is right behind the new restaurant, The Leaf, which was formerly the Parlor for those that are listening from Worcester that know where we're at.
Nice.
Great restaurant. You could try both the new restaurant and the new investment office in town. So
Excellent.
Thanks for having me.
Yeah, great. Appreciate you standing in and contributing to the team here. Well, with that said, let's get into the COVID, the deadly virus that won't. This is the last rung, I hope. This should be the last uptick with everything. So with that said, you'll see the COVID tracker, and obviously we had to spike up. It started with Europe about a month and a half ago. Europe had their spike. Obviously, United States, we had our spike. You can see that moving up. And then recently, though, is the Asia markets, Asia countries, Taiwan, South Korea, Japan. You see those spike up of the past few weeks, too. One thing I do want to point out is China. I find it very interesting how China hasn't really moved since the beginning of all this, and end of February, March.
It's funny how that keeps happening.
Yeah, so it's just interesting on that particular country how nothing's really moved over that time period. So with that said, it is what it is. Moving on to this other report that we get, and want to share with you this update too. So we started out, there were 40 trials, vaccines that are in testing. That's phase 1. Then you can see all the different phases. Finally, we got an approval. That was this week. That was Pfizer. Even the Queen from abroad got her vaccination. So if she can do it at her age, everybody should do it. So we're glad to see that. It's going to help the world population, obviously, and get through this. So a few more months of this spikeness, obviously, and then with the vaccines getting rolled out here, December, first-line workers, hospital users, doctors, actually the ATA, American Trucking Association, the truckers are in line to get it. So they want to, they keep the goods and services flowing too. So a lot there, but progress is being made. So we're glad about that.
Yeah, we have Pfizer this week, and I think Moderna's coming out next week with their vaccine, getting the approval. And a special thank you again to all the healthcare workers and those that are putting themselves in harm's way to deal with this.
Yeah, that's without them. Yeah, they've been through a lot. So with that, if you don't mind, let's transition to a little fun fact here. So I have to share with you. Today is the 33rd anniversary of Wall Street with GG, Gordon Gekko. So for those who can remember, and with that said, the best is this: Blue Horseshoe loves Anacott Steel. So that was a famous line. This is a shirt that I wear, and my kids and family, they love it, but I'm just a big 80s, 90s type guy. But my point is, today on a news network, they mentioned how it was the 33rd anniversary of Wall Street, and they mentioned Blue Horseshoe loves Anacott steel. So when I had that, I just had to bring this out, retro it. So for those, enjoy. Hopefully it brings back some good memories.
Much better movie than the second one.
Yes, yes. No, I hear you on that. But the Wolf of Wall Street, that was crazy.
That was great.
I'll leave it at that.
Blue Horseshoe loves Anacott steel.
All righty. So moving into some strategic things and what's going on, there's a lot that's happened. So I always like to just talk and mention, you'll see this too, there's certain things we can control, certain things we cannot control. One is we cannot direct the wind, but we can adjust the sails. So adjusting the sails is when you're going to be tactful. You know, if you tack on a sailboat, you move right, with the jib up, down, move right, left, etc. So this is a nice little picture I thought just talks about the overall economy, markets, what we can do to adjust. And we have made some adjustments and we'll continue to make adjustments. One being the economy. You've heard me talk about the quads. We have a lot of strategic partners within the research center. One is, Argus. We use Hedgeye, some other ones. But with that said, quads 1, 2, 3, 4. Quads 1 is spring, quad 2 is summer, quad 3 is fall, quad 4 is winter. So we're transitioning into the quad 2 sector for Q1 of 2021 and Q2 of 2021 as well. So the first half of next year, the economy should be in a quad 2 at this point in time with the information that we have. So with that, there are certain sectors and asset classes. This is just a visual. I won't necessarily go through it all, but just, whatever quad we're in, there's certain asset classes and sectors that we want to use. So one being, commodities does well in a quad 2. And gold does not do well. So that's why we sold off our gold for those models and positions that had gold. We got rid of that. So again, we'll be tweaking. We have been, but we'll continue to tweak the asset classes that we'll use for our models. And then for those who still have cash, we'll be redeploying the cash upon the next drawdown and or into, this is called the January Georgia runoffs there. So assuming the GOP, Republicans hold this 2 Senate seats, all we need is one of the two. And that's the blocker. The markets, you've heard this talk about before, the markets love gridlock. So if the new regime comes in and you have a House that's Democrat, and then you have the Senate that's Republican, that's the blocker. The markets love that. So not everything will get through that they wish they can get through.
Right.
Leave it at that. But so with that said, that's what we're going to be doing some other changes. In the near term, visually just show this up too. So this is interesting as far as the red speedometer here. This is coming from Rosenberg Research. So with that said, currently, this is at the end of November. We're at a 10.3 on a scale of 1 to 100. So you want to underweight equities in the near term. So that's where we're at. And it's just a scale of when you want to underweight, overweight, et cetera. And so meaning there's caution in the wind for the near term. And that can be over the next 2 months or so. So with that said, expect volatility. It's come down some on the VIX volatility index that we've talked about in the past. That has come down, but expect that to go a little bit higher over the next in the near term. In addition, this has come from Dave Hagen. I was on a webinar, again, probably on 2-3 webinars/calls a day, and this is from this week. And you'll see here, as we brought this up, and you'll see the last confidence reading. This is called the dumb money confidence reading, smart money, dumb money. But the point is, it's just the retail investors. So with that said, it's at 0.9. So we're going to show you, you're going to hear me talk out of both sides of my mouth. So I'm going to talk about the downside, and I'm going to talk about the good side of what's to come. So the downside is this. When you had a 0.9 reading on this, we're at the very high risk level. So we're above the red line. And going back to, again, coming from Dave Hagen, going back to 1998, anytime you're greater than 90% on this reading line metrics, only 8 times since 1998 have we been in excess of the 90%. We're at that right now. And when that occurs, the market, the S&P, the markets do pull in at least 9.5% or more, again, minus 9.5% or more over the next 3 months, with the average loss being minus 16.89%.
Oh my.
Yeah. So this is where I'm going to talk about near term, long term. So this is historic information. You can see it on the grid here. So it's past performance is no guarantee of future results, but it is something to be said. We're at the highest risk level here in a long time. So I want to at least point that out to you. I'm not saying it can happen. We're going to have an average 16.89% decline, but we are due for a good 5-8% pullback, which is common. So I wanted to mention that to everybody. So some of this, people say, well, Eric, what's driving it up? You're younger than me, but I remember the good old the .com days. I was working at T. Rowe Price at that time. So with that said, it's amazing how the IPOs. So the IPOs right now, year to date, are about 88 IPOs that filed on the U.S. exchanges, represents approximately $140 billion in IPO, initial public offerings, right, that have come to the markets this year. It's been a record since 1999, okay, right, that's .com. So with that said, though, what's scary is how many of these companies are, let's just call it running in the red. So remember running in the red companies? Remember that pet.com came out back in, if you can remember that. So that's a flag. So all these companies are coming to the IPO market, especially of this past few weeks. Airbnb, DoorDash. Yeah. I mean, these are all losing companies, but they're doing it because of the regime change and what's coming. So taxes, yada, yada, certain things will be occurring. So you have to watch out. This is I'm not going to say we're going to have a crash like the .com, but there's a lot of similarities, and you have to be aware of that. So with that said, we have to point that out. Now, again, it may not come to fruition because you have to have space and time. You can work off this over-leveraged situation that we're in just by time and grinding it out sideways. So the markets might just grind out, give up a little bit here or there, but might go sideways for another month or two before it takes off and does better. So, and like I said, I'm talking out of both sides of my mouth because nobody knows. However, you do have to use stats and historics and facts. But also, it's different this time because we have the PPP coming, so another round of money coming. So when you have low rates, and you have PPP stimulus money that needs to get to those folks who are obviously in need of it, and not bailing out certain states, then yeah, that's good. But I just want to, again, point all that out. Other things that come to fruition here is the 2-year, 10-year spread. So the golden cross is when the 50-day moving average on the 10-year has crossed above its 200-day. So it's interesting. Again, 50 days crossed over the 200-day moving average. It's called a golden cross. But when that occurs, what's that signaling is higher interest rates. So remember, going back to that visual of the sailboat, you have to be tactful making adjustments to the sails. So inflation's coming, folks. So we're going to be going back into other, again, commodities as well. And with inflation, rising interest rates, rates are going to rise even though the Fed will keep rates low for years. So we do not anticipate the federal dot plot, which you've seen before, I've shared with you, they're not anticipating them to rise from off zero until 2023. But they may do it in sometime 2022, end of 2022, because interest rates themselves, the 10-year, again, I talked about this last month, pushing up against that 1% mark. Well, the range is closer to 1.5%. So we might see 1.5% of the 10-year in 2021, and then more than that in 2022. So how you offset that is you have to, counter it with other measures that the Fed may do. So just technical here. I know it's deep in the weeds. Sorry about that, a little long, but just a lot of cross currents going on right now, and you have to monitor the interest rate risk on the short end and the long end, and et cetera.
And be prepared to move the sails in different directions as needed.
You got it. Yep. And with that said, let's talk about good old Tesla. So remember the FANGs, we mentioned that earlier on too. So with that, a new boy going to be joining is Tesla. So Tesla has joined the S&P 500 on December 21st. So December 21st, they're joining, and they're going to be within the S&P 500. There are 11 sectors: real estate, energy, financial services, consumer discretionary, yada, yada, yada. So with that said, Tesla is going to be tucked under the consumer discretionary asset class that makes up one of the 11 sectors within the S&P 500. It's going to be number 2 behind Amazon. So as far as market cap weight, it will be the second weighted asset, fund, or position behind Amazon within consumer discretionary. So if there's a hiccup in earnings and things of that nature, it's going to have a big drawdown and effect on the consumer discretionary, sector within the S&P 500. Things to be mindful of. That's all. Mm-hmm. But it could continue to go up, and then that space can continue to go up. Amazon typically seasonal. Amazon may go down a little bit. This is getting again stock specific, I guess, but. Right. Amazon, typically leading up to the holidays, it does well. During the holidays, it goes down, and then it takes back off again in February and March. So, and then there's a lot of year-end Christmas rally. Larry Williams is another gentleman that I follow. There's a year-end rally typically towards the end of the month here, and we've seen that before in 2018. I've taken advantage of that, and we'll probably be taking advantage of that, pushing a little more cash in between now and end of the year, and also definitely in January once we get to the Georgia runoffs done, and I think it's the 5th?
January 5th.
Yeah, January 5th.
Eric, do you see, as Tesla is joining the S&P, do you see that as any kind of signal, as you said, the regime change with regard to, as you say, consumer discretionary? Is Tesla joining the S&P? Folks have been asking me, does that mean that industries like Tesla with electronic cars, is that moving more towards where we're headed?
Environmentally, yeah. So the answer is yes. So it's a great question, though, Russ. That's awesome. So ESG. So I'm just going to read a little bit here. I had this stat I came across earlier. This is coming from Insight Fact Set. So Insight Fact Set is a strategic research partners that we use, and it's on December 7th. So ESG, a record number high of S&P 500 companies citing ESG, environmental, socially conscious, and governmental conscious on earnings calls. So companies, highest ever, 79 of them cited ESG and again environmental, social, and governance factors during the earnings call in the Q3. That's the most ever since this has occurred. So the slant is companies are becoming more consciously aware in this space, and again under the new regime, that's going to be on top of mind. So you're going to hear a lot of catering to that. So yes, great point, and there's more of that coming for sure. Moving on to just sort of like wrapping up the year into next year, what do we see? Again, multiple things. So Argus, one of our research partners, they mentioned quarterly earnings. Someone talked briefly about annual real gross domestic product, GDP. So with that said, I'm just going to cut to the chase. So quarters can be up and down, 3% range, what have you. But for the next year, they're saying 3.6% is GDP growth rate for 2021 based on their forecast for GDP coming from Argus. Another partner of ours is a little bit not as aggressive. They're forecasting 3%. That's from First Trust. So 3% GDP growth rate, which can easily go a lot higher. Brian Westbury, phenomenal tracker and analyst, he was able to determine a little more on the conservative side, but they're projecting 3%, which could go a lot higher based on if a few things go right. So moving into the S&P 500 returns, what's projected, again, I'll just start out with First Trust. They're saying roughly 15% return for the S&P 500 in 2021, which would be fabulous.
Yes.
Yeah, I mean, it'd be great if we can do that. And then JP Morgan, they mentioned the low teens. That's fine. True North here, we're not quite as optimistic, but we'll see. All these numbers change as more information comes in. But high single digit is what we're saying. So high single digit, 8-9% for the S&P 500, and it could be a lot greater if things go better than anticipated. So
Still pretty good.
still pretty good. Yeah, that's hitting the averages for the most part, and we're there. So volatility should pick up a little bit in the near term. Hopefully level itself out. First half of the year in summarizations, first half of the year of 2021, first 6 months should be a lot easier comp-wise because you do earning comps, first quarter, second quarter comps of 2021 versus first quarter, second quarter comps of 2020. Night and day, we're going to blow them out. It's the back half of the year. That's the other foot that hasn't landed. That's when you're going to get tighter. It's going to be a little more challenging. So we'll see how that all shakes out. So again, not that anybody knows exactly what's going to happen, but with this information stuff that we track, you do try to project and do as best one can going forward. This again, just talking about pullbacks, stock market pullbacks. This is coming from our another strategic partner, Clearonomics. What they mentioned here, so far year to date, we've had 12 S&P 500 pullbacks of 5% or more. Wow. So 5% or more is common. We've had 12 this year. That's dating back to the .com 2000, as you can see on here in the charts. 12, coincidentally or what? A lot of things are lining up here. So I question. So 12 and 12, but it pales. It's half the amount in 2008. So 2008 we had 24, as you can see, pullbacks of 5% or more. 12 this year so far, and 12 back in the .com. So I just want to point those things out. It is common. It does happen. Don't freak out when they do. And if there's cash, we push cash in, et cetera. Mortgage rates. You've heard us talk about mortgage rates. We're going to be mentioning our strategic partners coming up, David, and we'll talk about housing. But this is a good time just to share with you what the mortgage rates look like. Right now, 2.7%. All-time low is free money.
Right.
So go ahead, go get your mortgage, go get a 30-year, load it up. So that's good. It's good debt, bad debt. That's good debt to have. So no problem.
No matter what, it's worth a conversation with your bank.
Yes, that's exactly right. It's worth getting all the paperwork together and going through all that. So green light, go get that mortgage before rates go higher, folks, because the 10-year is going higher, and the mortgage rates reflect off the 10-year. So you heard it from me. I've been pounding it all year long. Andy, Russ, we need to, if you're going to do it, this is the time to do it because rates are going higher. So I guess wrapping it up, TSA checkpoints, just a few other things to point out. So we were doing over 2 million flights a day, went down to like under 100,000. And right now, this is coming through December 4th, there's like 738. So we're less than half flights. And I'm hearing it's still flights will come back. There'll be a pop once we get the vaccine. There'll be a huge surge in travel, pent up demand. So that's the first half of the year. Great, gravy train, free money, parties on, and then things will get tighter in the back half of the year. So just be aware of that. Restaurant activity still suffering, and unfortunately, it looks like New York, the governor up there, he's going to be locking down indoor dining effective Monday. Next Monday. It's like
what a nightmare.
Yeah. So I feel sorry for those states and those people that are sort of stuck.
This month's strategic partner, David Baker, with Baker Realty Group, is not affiliated with True North Wealth Partners or Stratus Wealth Advisors.
Welcome. We have our strategic partner, David Baker, with Baker Realty Group. Welcome to the Vantage Point with True North Wealth Partners.
Oh, thank you, Eric.
Yeah, it's good to see you. And I know we've seen you around the office here and there and helping people out, so we appreciate that and our relationship with you. So thanks for that.
Sure.
Just wanted to maybe introduce our clients to you and your background. Maybe tell us a little bit more about yourself, what you've done over all these decades.
Yeah, decades. Well, decades it is. I've been in real estate now about almost 20 years, and it is my third career, so I am well-rounded.
Excellent.
But I got into it right in the middle of the big housing boom. I just got into it, and there's a lot of people poured into the business, and I jumped into it and loved it.
Great.
And so I think I've had my own company now about 17 years.
Nice, beautiful. That's good times, and I know you've seen a lot, thick and thin. It's
yes.
But I guess
I've ridden it up and I've ridden it down. I've ridden it back up.
Yeah. And I know you're more of the residential side. Let's just talk briefly on the commercial side.
Sure.
So what are you seeing, or what sort of flags are there for you that you're seeing from the commercial side?
Well, being in real estate, you kind of hear what's going down, and the irony is that the residential side has not been impacted near as much as I think the commercial will, because I mean, who steps foot in a mall anymore? Right. And so I think a lot of people holding on some of the commercial stuff, it's going to take a hit down the road.
Yes.
Some people think a lot of the banks are going to be holding on to those after a while.
Yeah. Right. Amen. And to that point,
Office space. How many people are ever going to go back to the office?
Yes.
You know?
Yeah. So to that point, we talked about REITs, real estate investment trusts. So we owned it earlier on, and we've exited to REITs, real estate investment
These
trusts.
guys are smart.
Yes. So
I would be out of it too.
Yeah. So there's certain asset classes. So we talked about how we exited gold leading into next year because inflation will be going up. So REIT is another spot we don't want to be in at this point in time. Maybe later on, but not now. So
it's interesting because one of the trends I'm seeing is a lot more commercial investors getting into residential, competing with home buyers.
Interesting.
Just wanting to buy it and add a bunch of single families to their portfolios.
Yeah, no, I hear you on that. And then, as far as like 19 versus 20, and what do you anticipate for 21 next year? So maybe just walk us back 19 versus 20.
Yeah.
And then next year.
Well, honestly, the residential market has been on fire for almost 7 years now. Wow. And last year was a little bit of a slower year. I'm not sure why, but last year was a little bit slower. It could just be my business, but this year I'm up about 20%.
Beautiful. Wow.
And in the year of COVID, you would think it'd be slower, but no, it's been faster. But because I think the virus has not been enough to slow people down in terms of residential mortgages, residential housing.
Is it? Do you think primarily because of the mortgage rates have decreased, or what's the?
That I think is a primary fuel to the fire because there's already a shortage, and the economy is still relatively good for people that are buying homes. A lot of people losing their jobs, I think, are kind of in the service sector. Unfortunately, I think the lower rungs of the ladder are the ones that are hurting the most. So most people are still fine enough to be able to buy a house, and so that's kept residential real estate humming right along this year.
You mentioned a shortage.
Yes.
So talk about that. I think it's like around 3 months is the supply.
It's a very tight inventory.
Yeah,
I think the average days on market maybe less than maybe like 13 days, something like that. And so unless the house is a disaster, it sells right away. I've heard someone estimate that there are 20 buyers for every house to let you know how much it's imbalanced. Wow. A balanced market, you roughly have a few more buyers than you have each house, but now it's like 20 to 1. So we are in a very strong seller's market.
Wow, that's something. So for those of you, I guess that leads me to my next point. What would you suggest those folks who are listening and hearing about that, thinking about maybe wanting to scale down and or get their house prepped or ready for beginning of the year. Here's January coming right in the corner. So let's get 2 more months. You're off and running the races again. So here we go.
It's
what do you suggest?
Believe it or not, it's already kicked off. The slowest time of year is November. October, November. Yeah. Those are the months where it slows down, and I am kicking start again now that I'm getting in December. Wow. A lot of buyers are locking in with the new build because that's one of what's taking the strain off is new construction is up about 7 to 8% per year right now. Nice. And so, but getting ready to sell that again, it's going to vary. House to house, people to people, but in general, I tell people it's cosmetics. Yeah. It's just clean, declutter, paint and flooring, carpeting.
Gotcha.
I try to keep it real simple. Don't rip out your kitchen. Don't do that. But just make it super clean. Yeah. Clean is the main thing. No obvious repairs.
Curb appeal.
Yeah,
outside.
That's part of the cosmetics. Is I've heard people say when they pulled up in front of a house, this is it.
Okay, wow.
So obviously there's nothing in the front discouraging that. And so I just think the curb appeal and then the cosmetics inside make a world of difference.
Awesome. All right.
I call it the polish on the apple.
Ooh, the polish on the apple. And then would you say the lower interest rates are like catnip, maybe?
That is, you stole my term. You told me they're Eric, but I call it catnip for buyers because the rates are so low right now. I've got a lot of people getting 2.75. You guys have already talked about it, is my understanding.
The rates, that's correct.
And that, like I said, that's adding fuel to the fire. That's kicking it into turbo drive, low interest rates.
And then, so folks, we've talked before, rates will be going higher. The 10 years anticipated to go higher. 1.5% next year, which has effects on the interest rates, which will, rates will go higher for 30-year mortgages, 15, et cetera. Yep. So that's what we're seeing, anticipating for 2021. Okay. So this next, like I said, the front half of 2021 will be easy times, easy money. So if you're going to do something, do it in the first half rather than the back half. Be my suggestion, but this is the specialist.
I've given up predicting mortgage rates.
Yes. Yep. So understood. Well, great. Well, for those of you who want to reach out to you, I think it's, Baker Realty Group. Yep. So share with our listeners and watchers how to get a hold of you.
The best way is you can, my website is great, bakerrealtygroupohio.com. My cell number, 614-989-5662. I'm always on call, as my wife will attest.
I hear you about that.
Real estate is a 24/7 business today.
Yeah,
it just is.
Yeah. Well, we appreciate your insight and little tidbits there and what we can do to help people going forward. So Happy New Year to you and your family.
Thanks, Eric.
Thanks for coming in.
Glad to help.
Thanks, Eric. So with that, anything on top of mind? Any tips of the month that you may have, or I would like to end on something?
Well, as an estate planning lawyer, my tip for people is always to, especially this time of year, through the COVID time, people's situations have changed, their lifestyles have changed. It's probably a good time to review your will, or whether you even have a will, whether you should get one. Medical powers of attorney, financial powers of attorney, all good documents to have. Whether they need to be updated or whether or altered or even created. I always recommend that for people. If you do, check them every 2 or 3 years. And that on top of the fact that we're getting towards the end of the year here, which means taxes are going to be coming due in April. Yeah. So it's probably a good time if you're still eligible to put money into your IRAs, if you're still able to do that, to consider be doing that.
Amen. Yep. Easy way to put it in. So the max is $7,000 for those 50 and older. $6,000 if it's under 50, and it's a Roth or IRA. You can't do both. It's one or the other, not both. Right, good points, though, Russ. Appreciate it. And Merry Christmas. Hey, here you go. Look at all that. So this is prospectuses, junk that our industry has to prevail out to the custodians. So mutual fund firms has to provide prospectuses, shareholder communications, things like that, which are big documents. All this goes away. So our industry finally is getting ESG friendly. So effective January 1st, 2021, the U.S. Securities and Exchange Commission has adopted a new rule that the fund firms no longer have to mail out these, which is through the custodian, to the participants who own these securities. You will get a letter mailed to you stating that, hey, go to the website and you can look at it there. And for those of you, a lot of our clients are already on e-delivery for most everything. So e-delivery cuts it down anyways. But you'll just get a notification saying if you want to view any of this, there's a web link that will be provided. So all this lovely stuff. We save a ton of trees. Thank you.
My wife will be so happy.
Yes. So we're very pleased about that. So folks, thank you. We appreciate the partnership and entrustment that you've had with us this year. Again, mask up, stay well, healthy, enjoy the holidays with your family. Play games with the kids, enjoy the time because it's been a challenging year, and we do appreciate it. And stay well, and thank you very much, and Merry Christmas.
And happy holidays, everybody.
You can reach this episode on our website at mytruenorthwp.com, by other podcast venue sites, or by calling us at 614-929-2715. Also, feel free to share this episode with friends and family and sign up for our weekly email market updates via our website. Special thanks to our producer Nathan, as we will be producing these episodes on a monthly basis. Investment advice offered through Stratus Wealth Advisors, LLC, a registered investment advisor, DBA True North Wealth Partners. Investing involves substantial risk. True North Wealth Partners and Stratus Wealth do not make any guarantee or other promise as to any results that may be obtained from this. The opinions voiced in this material are for general information only and are not intended to provide specific advice or recommendations for any individual. The economic forecasts set forth in this material may not develop as predicted, and there can be no guarantee that strategies promoted will be successful. No reader should make any investment decision without first consulting his or her own personal financial advisor and conducting his or her own research and due diligence.